Hi, it's Peter Schiff. This is Monday, August 3rd, 2009. Well, the global stock market rally continues, as does the dollar rout. Markets were very, very strong overnight, particularly any of the stocks related to the commodity sectors. The Asian markets continue to lead the way. U.S. market, the Dow is up better than 100 points today, but the U.S. dollar was down by about 1%. That pretty much negates that gain in real terms. But the dollar made a new low today for the move. It closed um, with a 78 handle. This is the lowest it's been since September of last year. It's the lowest, certainly, of this calendar year. And, as the markets are rising, people are assuming that this is indicative of the problems being largely behind us, that the recession is coming to an end, and that this is reason to be optimistic about the U.S. economy. This is not the case at all. I mean, first of all, remember back in late 2008 when the dollar was rising so much and when foreign stocks were weaker than U.S. stocks. Think about what all the Pollyannas, all the perma bulls were saying. They were saying that the reason that the U.S. was relatively strong was because, as bad as the problems were here, they were worse every place else. They were saying that we were the first into the crisis, and so we were going to be the first ones out. That we were really tackling these problems. That Ben Bernanke was on the job, and Congress was on the job, and we were being bold with our stimulus, and that the rest of the world was being too timid. That they weren't doing the right things. That they were dragging their feet, and therefore the dollar was going up, and the U.S. stock market was not as weak because we were going to lead the world back to recovery. Well, I knew that was nonsense back then. I was pointing out that, there was a financial crisis abroad because the world loaned us all this money that we couldn't pay back. But in America, it wasn't just a financial crisis, it was an economic crisis. And as the financial crisis is abating abroad, the economic crisis is going to play out more dramatically here at home. If you look at what's really going on, if you look at where this recovery, if a global recovery is underway, is coming from, we're not the leaders. It's coming from abroad. The economic numbers, the data is better outside the United States than inside the United States. And certainly the stock market performance, I mean, the U.S. market is standing still or going backwards compared to what's happening abroad. And of course, the dollar is no longer strengthening. The dollar is dropping almost every day. The dollar index, again, I think is within 10% of now making an all-time record low. And I think there's a good chance that by fall, we will be below 70 on the dollar index. And I think that is what is going to usher in the new leg of our economic crisis. Because what is actually playing out right now, I think, is decoupling. It's what was so discredited by short-term market movements in 2008. It's happening right now. What the strength of the global economy is decoupling. But what most people don't understand is what is being decoupled is the American caboose. That the world, the engines, and the rest of the cars are going to move along the tracks a lot faster once the United States is decoupled, because we have been a drag on the global economy, because the world has had to produce extra so that they can produce enough for us. And we've been using or wasting or squandering so much of their savings that if they simply stop loaning their savings to us and we just use them on consumption or to grow our bloated government, those savings would be available to be invested productively outside the United States. And if the world simply consumed what they produced, as opposed to giving it to us, that they would enjoy an economic boom and a rising standard of living. And I think that process is fully underway. And that is what we're seeing. We are not seeing the U.S. economy recovering and leading the global economy, which is what everybody was hoping was going to happen or was pretending late last year. It's actually the reverse. As the world is licking its wounds from the financial crisis and absorbing those wounds, the global economy can resume growth. Because outside of the United States, in general, the economies are sound. I'm not saying they're perfect, but they're sound, they're viable, and they are growing. It's the United States that has a unique problem because our entire economy was phony, or the bulk of it. It was built on this financial pyramid. So the global financial crisis, the root cause was the U.S. economic crisis. It was these massive economic imbalances and the problems in our economy that initially led to the financial crises of 2008, both here and abroad. But as the world digs out from under its bad decisions and bad investments and continues to prosper, we are going to be in trouble. Because remember, initially, the decline in America was cushioned by the problems overseas. We were the beneficiary of that flight capital. It was all that money coming into U.S. treasuries, coming into U.S. dollars, that put a floor under our economy, that made it possible for the government to find buyers for the debt so that they can do the bailouts and do the stimulus. As misguided as they were at least able to get these policies through. And so we benefited. We benefited because interest rates were a lot lower than they would have otherwise been. Commodity prices and consumer prices were a lot lower than they otherwise would have been. But now, as the global economy is resuming growth, all those flows reverse, and the dollar is falling. So our bonds are going to fall, which means interest rates are going to rise. Commodity prices are going to rise. Consumer prices are going to rise, and they're going to rise a lot. They're not just going to rise a little. Oil, I think, was up almost $2 a barrel today. We're back over $71. I still think we could be above $100 a barrel by the end of this year. And it's not going to stop at 100. And it's not just oil prices. Food prices, I think, are going to go up even faster than oil prices. And what's going to happen is the unemployment rate is going to keep getting worse. There is no change here. The government is not allowing capital to flow to businesses that need it to expand. It's using it all up to keep government big and to prop up companies that need to fail. And so there are going to be no jobs for the people who lose their jobs. So the unemployment is going to keep getting worse. But the problem is now the unemployed are going to be confronted with sticker shock at the gas station, or even worse, at the supermarket. And even those that still have their jobs, they're going to be spending more and more of their incomes on food, on energy, on taxes, on higher interest rates. And so our situation is going to get worse. And the global economy is going to improve. But I do think that we're going to see something disrailing the U.S. market rally, and I think it's going to be the weakness of the dollar. I think at some point, probably around maybe by September, the weakness in the dollar is going to begin to be seen as the problem that it is. Right now, no one's really paying much attention to it. But once we get down to record lows, once you see that dollar index down around 70, once you see the euro above 150, and we see gold above 1,000, and we see oil, above $80 a barrel, then people are going to start to appreciate the inflationary ramifications of what's going on and the predicament that the Fed is in. Because Ben Bernanke is going to have to face the music a lot sooner than he thinks. Because probably by the end of this year, the Fed is going to have to start raising interest rates. They're not going to be able to raise them 2 or 3 years from now, like Bernanke pretends. We're going to have to raise them now. And if we raise them, it's going to be a huge problem. And if we don't raise them, it's going to be an even bigger problem. And that is the Hobson's choice. That is the box that we're going to be in. And the problem is most of the forecasters out there, they all they can see is what's happening right now. That's why they're always so wrong. They can never connect the dots, even though it's so obvious how to connect them. They don't understand how strengthening global economy means higher interest rates, means higher consumer prices. They don't understand the bind that puts the United States in, that it puts the Fed in. They don't realize that this country is on life support right now, and we're going to have to pull the plug. Our phony economy is being propped up by the stimulus and artificially low interest rates, and all of that has to come to an end if we want to stop the dollar from collapsing. If we want to put a lid on runaway inflation, we have to pull the plug on that life support. And we have to let this phony consumer-based asset bubble economy completely deflate. And that's exactly what our politicians don't want to do. That's exactly what the Federal Reserve doesn't want to do, but it's going to happen. And if it doesn't happen, the alternative is even worse. Anyway, that's it for today. So long, everybody. I'll be back again soon.